Hello and welcome to another episode of Nothing Ventured with me, Arya Shah. Today in the studio with me, I have Eva Yazhari. Eva is a classically trained Wall Street investor turned emerging markets VC. At Beyond Capital Ventures, she backs need to have health, fintech, mobility, and climate plays across East Africa and India, pairs equity with a credit strategy, and runs the firm relationally, not transactionally, with deep diligence, portfolio management, and genuine diversity of thought, not DEI, not slogans. A top quintile track record with a near zero loss ratio and a thesis that cuts against Silicon Valley fashion. Let's pressure test it. In today's episode, we talk about why in DD you start with a relationship.
Typically, when we start our due diligence process, that's where we start with the really relational approach. And I actually believe that ends in a better outcome.
Capital, time, relations, and resources are the key pillars to investing for Eva.
We've helped our founders, to give you a metric, in Fund 2 mobilize 10 times the amount of money that we put into the businesses.
How Beyond Capital Ventures incentivize founders with carry.
We also give an incentive to our founders to earn carry in our own fund.
Why large corporates understand the future of global growth.
They are ready and ripe and excited to capture market share in Africa and India. And the one way to do that is to acquire a local solution.
How customers, competition, and conscious leadership are key.
What I mean when I talk about diversity of thought is customers, competition, and conscious leadership.
How 75% of world's growth will be in the Western Indian Ocean region by 2050, and why Japan just put in a strategy around it.
75% of the world's growth will take place in the Western Indian Ocean region, meaning East Africa and India. And I believe that's by 2050, if not sooner.
How Indians are thinking about Africa just as much as Africa is thinking about India, and how valuations are 50% cheaper than US equivalents, but that doesn't mean the exits are.
In Fund 2, we invested at half the US Series A valuation on average across the portfolio. Although, there could be an argument made that the valuations or the kind of exit multiples are not as high. But that being said, when you invest in quality, I think you do quite well.
Let's get straight into it. Hey guys, whilst I've got you for a second, I thought I'd reintroduce myself. My name's Arya Shah. I'm the host of Nothing Ventured, the podcast where I talk to the people behind the stories that make the venture ecosystem go round. I'm also the founder of Emerge One, a consultancy that provides fractional CFO support to venture-backed tech startups from seed to Series B and beyond. If you enjoy the podcast, I'd really appreciate it if you could subscribe, rate, and like wherever it is that you listen. And if there's anything you'd like to discuss with me, do reach out to me on LinkedIn or X. I'm always up for a chat. Right, let's get straight into it. Eva, thank you so much for joining me here today. Really happy and pleased that you can make it all the way from the US to join us in our little studio. So thank you so much.
It's a pleasure to be here with you.
Amazing.
Thank you for having me.
We're gonna jump straight into to some fairly deep questions, actually. I think potentially because I'm incredibly interested in what you're doing at Beyond Capital. But you said that in VC, relational beats transactional, but too many VCs focus on the latter. I definitely couldn't agree more. But let's see if we can prove it, right? So when did a relationship first approach materially change an outcome, whether that's a hard follow-on, a rescue, an M&A path, that a transactional VC would have lost? And you cite a high sort of NPS, right? Net Promoter Score. How do you measure it and translate it into better pricing, better distribution, or even better governance? And on kind of diversity of thought as a theme or as a topic, is this just sort of DEI rebranded, or can you name a time that the team's sort of disc mix made you change a term sheet or walk away? I know that was quite a lot in one question, but yeah.
So when it comes to relational over transactional, thinking about a specific example, typically when we start our due diligence process, that's where we start with the really relational approach. And I actually believe that ends in a better outcome, because when we finish our due diligence, which in some cases on the venture side can take 3 months, on the credit side, it is way shorter than that. We can underwrite in 3 to 4 weeks, but we already know those companies because we only lend to our venture fund portcos. So in the case of the venture DD, when we get to the end of that due diligence, we really understand who we are investing in. And at least from my background of having observed Madoff and FTX and all of these big blow-ups, including some funds in Africa that I think have been overly transactional and not produced the highest quality or integrity in their businesses, I know that it's number one most important to understand who you are investing in. And so starting with the due diligence process in any company that's in the portfolio, that's where it's really played out. The other area is that it's benefit our businesses in the sense that they will come to us knowing that we will listen to them, that we will be willing to hear what's not working, and then we can properly put in place the right interventions. And if we can't do that as an active investor, then we're just prescribing things that we think they need, a la private equity in the US, where, reporting pages are 90 pages long, reporting documents are 90 pages long, and they don't always fit the purpose of the company. So our relational approach, I think, flows through into a company like Ampersand, for example. And Ampersand is East Africa's leading e-mobility business. They manufacture the bikes, they own the batteries, and they have battery swap stations in Kigali and Nairobi. And so they're building out the infrastructure for e-mobility. Through our relational approach, we've provided the company with not only support around the business model, help kind of thinking around maybe directions that they should go or not, even off balance sheet financing for their battery fleet. But we've also helped them with raising capital when they've come to us when they've had kind of like a dearth of capital or needed a reference. And then what this has really culminated in is us having access to better deals or better deal flow. So when they raise their next round at favorable pricing, we were able to add that position as a warehoused investment to our third fund.
And just whilst you were saying that, the thing that strikes me is in Africa, especially, and I hate talking about Africa as one blob, but in general, you have, I guess, you have a less mature ecosystem as far as venture is concerned, but equally in terms of kind of talent and talent density. So you can't go into Africa as a VC with a hands-off approach because apart from anything else, it's not going to do your fund any favors because, we've been approached by a number of African startups over the course of the last several years where it's really clear that access to, say, talent in finance or product, right, or potentially engineering, although there are, more and more great engineers coming out of Africa, they're still quite early in terms of sort of the experience they've had and that kind of real friction test working in big projects or in big tech. And therefore, if you don't have those relations and those relationships as a VC investing in Africa, your job is going to be that much harder, assuming that the outcome of your job is to return capital back to, obviously the fund and the LPs, right? Absolutely.
I mean, when we want to sell our stake in a company in a secondary sale, which is a very typical VC exit route, the relationship is what helps drive that outcome. It would be strange to be a passive investor and then all of a sudden show up and say, we want to sell our stake. What do you think the founder is going to say? He or she's going to say, where have you been the whole time? Would you mind restating the second question?
Well, there's a couple of things, right? So I think NPS, right? How does that translate to better deal flow or better governance or better distribution? And then maybe a little bit about how you think about diversity of thought, which I know is a key kind of pillar for you as well.
Right. So the NPS is measured by asking our founders if they would be likely to refer us to other founders. So that's basically the question standard that we ask them. And the standard NPS for us producing a 93% NPS is that they would be highly likely to refer us to other founders. What that means is that all of the inputs, including of our kind of portfolio management, so that is capital, it's time and resources. We've pitched businesses during pivots back to the founders and kind of put in place frameworks for ESG reporting all the way through exec comp consultants that we've brought into businesses. I mean, the list really goes on. But that's kind of our main area where we pour in resources. We also give an incentive to our founders to earn carry in our own fund. And then finally, we've helped our founders, to give you a metric, in Fund 2 mobilize 10 times the amount of money that we put into the businesses. And as a result of that, we've also provided them with debt capital as they've kind of been able to raise more equity and have strong debt to equity ratios through our own fund. So we've put together effectively 4 areas where we really excel. And in these areas where we excel, that is what has comprised our NPS. But why does this matter? This matters because we're a founder magnet. Because founders, when we're not even in the room, will rank us on boards at conferences as one of the top investors that they would want to have on their cap tables. Because when we take meetings with pipeline, we can tell that companies are eager to speak with us. We attract the right quality deal flow, or frankly, the right throughput of deal flow, and we have a 2% selection rate.
Wow. So actually, just whilst you're talking about that, so one of the questions that I guess comes to my mind is, Africa, again, is not a mature ecosystem from that perspective. So you don't really have that many early stage investors in Africa. Like I remember on one WhatsApp group I'm on, I think an African VC came on and said, hey, we're looking for businesses to invest in. Minimum criteria, they must be doing like 2 million EBITDA. And I'm like, okay, well, you're a private equity investor. You're not a venture investor, right? And obviously there is this perceived risk, right? With investing in African businesses. So presumably a lot of your portfolio will be domiciled in Delaware. Is that correct? Right?
Yes.
Okay, fine. But how how do you think about that, right? Because who are you competing against, I guess, right? Like in terms of deal flow.
We have competitors.
Right.
There are probably a half dozen number of small funds like us who fund in the early stages. Yeah. So we do need to stand out. We do need to differentiate. Sometimes, though, we fund later stage companies. And when we fund later stage companies, that's where having the high NPS and being a founder magnet actually matters, because we want to win an allocation.
Yeah.
So let's say it's a $3 million round, which seems small for other environments, but we're only writing a $500,000 check.
Yeah.
What makes us meaningful, one of the things that makes us meaningful, because there are more, is our ability to show that we are founder fair. We are founder first. We don't believe in the founder friendly term because we think that that's kind of BS.
A bit ick, yeah.
Yes, exactly.
How can I be helpful?
Exactly. How can I be helpful, in air quotes?
Yeah.
And so the NPS also helps us with preferred allocations in certain like hot deals, or just getting us to the front of the line. We do have competitors as well. And we do cultivate relationships with follow-on investors to kind of go further on your thought of the ecosystem being a little immature. It's growing, and there is more capital jumping into the pool.
So one question, I know we're kind of going off on a slight tangent here, but I am intrigued. Like, where do exits happen for Africa-based ventures? Like, presumably they're not IPOing, certainly not in Africa, although I guess that could be possible. But, are they being acquired by multinationals on the continent? Are they essentially moving operations to the US and looking for acquirers there, or are they IPOing there? Because again, the thing that strikes me is, we talked about it in terms of M-Pesa, I think, when we first spoke, right? Like, a lot of solutions that are built in Africa are Africa First solutions.
Right.
And rightly so, because there is a massive growing middle class, there's a massive growing population that needs to be served and is not being served by Western tech in the same way, right?
Yes.
I think about, for example, like Ubers are great in Kenya, but how many people know about border, right? And the fact that you can jump on a bike or a scooter as a second passenger, and that is actually a very, very common means of transport for many people, right? But it's a very Africa solution.
Sure.
Maybe similar in other emerging economies or developing economies, you may find sort of similar things happening there. But so like, how do you think about it from an exit perspective?
Yeah.
Right? And can you command the kind of sort of multiples at exit that make venture venture, right? Like, I mean, essentially, if you're shooting for kind of unicorn returns, is that possible in an African situation?
Yeah. So we've underwritten our investments kind of between 5 and 8x in both environments, in both regions where we invest, just to kind of give a number of expectations. We do believe in less of the power law, one investment is the 100x and then few 10x's and the rest are like losses are subsidized by the winners. We believe in a more consistent band. And I do believe, especially in the need to have access in the sectors where we invest, health, financial services, agriculture, mobility, that those returns are achievable more consistently. But I think to really answer your question, what is important when you think about just exits is a couple things. Like secondaries are doable, but how many strategics or how many corporates or kind of players that could be strategic acquirers are already on the cap table or partners in the business early on? 60% of our Fund 2 portfolio companies have had strategics as partners in the business and or investors on the cap table. And we screen for that, and we believe at our firm that exits start on day one.
Yeah.
And so we are always looking for, where is Total Energies involved in Ampersand? Where is Bayer or Sanofi or Johnson & Johnson? I mean, they're all involved in a number of our companies around the health distribution and pharmaceutical distribution.
And we don't think about those as being Africa first, but they are like, they have massive, massive presences.
Right. Well, they're global businesses.
Exactly. Yeah.
And I think the last question is, what are they buying? They're buying market share.
Yeah.
So even if a product or service is created for Africa, large corporates understand the future of global growth. In many ways, they've saturated markets in the US and Europe. And so they are ready and ripe and excited to capture market share in Africa and India. And then one way to do that is to acquire a local solution.
Which makes a huge amount of sense, right? Because I think exactly to your point, right? We feel like we've reached a maturity level in the West, right? Writ large, right? Like how much more can we consume? How many more credit cards
do you need?
Yeah, exactly. Whereas in Africa, in India, in Southeast Asia, other areas, LATAM as well, for that matter, we're nowhere near maturity there.
Right.
Yeah. And just on that point around diversity of thought, which I guess
I love that question.
Yeah. I mean, it's a bit of it's always difficult, right? Because, this is not a diversity podcast, but we try and be as diverse as we can, mainly because most of the venture podcasts out there aren't.
Yeah.
But it's also one of these phrases that I'm always like, okay, what are we actually talking about here? So can you unpack what it is that you mean when you're talking about diversity of thought?
Yeah. I mean, what I mean when I talk about diversity of thought is I'll go back to a framework that helps us understand our companies in due diligence, and it's customers, competition, and conscious leadership. And what's important for us in conscious leadership is understanding that a leader is equipped to do the job. Being a CEO is hard work. You are being hit from every angle by all stakeholders, whether that's your shareholders, your customers, your board, the government, the community that your company is operating in, the climate in certain cases, depending on what type of business you're working in. And so we believe that conscious leaders who are really defined as leaders who are thinking about all stakeholders are the best leaders for the future of global growth. I would say they're also the best leaders for our current kind of reality, but we don't have many great examples. And so we're looking to cultivate the future leaders who are building financially successful and commercially successful businesses, but that also do recognize the world around them and don't operate in a vacuum, so that if there is if there's an external shock, their companies are shielded.
Yeah.
And it's a risk mitigation tool.
It's a kind of anti-fragile mentality.
Now, exactly. So how does conscious leadership relate to diversity of thought? Well, in going a little farther, because our team has the benefit of having been coached, we started to realize that certain people are good at certain things. And we use the DISC framework for anybody that knows it: drive, influence, stability, and conscientious. And sometimes they have other variations if you look at different versions of it online. But all it means is, what is a founder's main motivator? So I'm actually drive and influence. We happen to be particularly rare. 8% of the population are drive and influence focused. What that means is I'm a great communicator. I'm highly relational, but I'm actually not very structured. Does that sound
a little
like
bit familiar? Not.
And so
saying.
what I need to know about myself as a leader is that I also need to be augmented by structure.
Yeah, 100%.
Whereas those who might be more steady and conscientious aren't great at raising money.
Yeah.
Maybe aren't the most relational, shouldn't be in the sales role. So we try to understand our founders so that we make sure that they just have the teams around them that can support their skill needs. And that's where diversity of thought comes in. It's, we have a portfolio of all different makeups of these 4 behavioral types. And we believe that brings strength to the portfolio, because if we only have salespeople, there may not be anything underneath those companies. And if we only have engineer types, who are typically the S and the C, but there's nobody to sell their beautiful products, then they won't get their product to market, or they won't raise capital. And that is a major risk. So that's why diversity of thought matters. We're big on diversification as a portfolio, not only the 2 geographies and the multi-sectors, but then again, this is where we wrap in some additional diversification.
Yeah, I mean, I'm sort of giggling away because, so I did back in, I think 2014, 15, I did this, the Gallup Strengths Finder, which is kind of a similar sort of thing. And so mine was sort of maximizing and communication and knowledge or something weird. I can't remember, but I'm I personally am very good at supporting others, and, getting the best out of them. But I'm also really, really rubbish at the granular details. So in my business, knowing that about myself has been massively helpful, because I bring in the people that are better at that stuff than me, right? So I have a COO who deals with, the contract wrangling and, maybe piecing together some of the workflows that we have, and dealing with the kind of nitty gritty around, employees or whatever it might be. And I think framing it from that perspective, as opposed to just a straight lens of diversity, is really important, right? Because I would agree, in any business, you need that spread of talent, and of thought. And not only that, we've had someone on the podcast, I remember, and she said, if you think about it, she was at a talk, and a lady was on stage, and she said, she reached into her handbag and she pulled out her phone. She goes, I can tell you, if there was anyone on the iPhone team that was a woman, we would have not ended up with a black iPhone. And I was like, I don't get that. What do you mean? And what she said was, what this lady was basically saying was, if you've got a handbag, searching around for a black phone is pretty tough. And therefore, if there had been a woman on the team, you may have had a different outcome, right? So it brings, I think, having that diversity of talent and of people helps bring different perspectives, which hopefully will not only make your business better, but it'll make your product better,
right?
Your service, how you deal, how you engage. To your point, can you raise capital? Who do you bring into those conversations? How do you sell? And how do you think about selling to different population groups, right? Because the other thing in Africa is, people talk about Africa as a homogenous place. And as I've said, it's not. And how you sell to, a guy sitting in, I don't know, in Kigali is different to how you sell to a guy sitting in Ruru or in, or in Mombasa or whatever, right? And even within Kenya, as an example, the difference between coastal populations versus inland populations is again, really, really different. So you need to be able to have that, I think, breadth of thinking, right?
Yeah. I have 2 more things to add. One thing that's really important in thinking about diversity across our portfolio companies is that while we are actually a gender lens certified fund, and we're a female GP, we're kind of an anomaly in that way. Women will not be working in certain parts of the economy in India. They will not be truck drivers. Of course, they won't be construction workers, but like there's a very specific role that women would play. And moving outside of that actually moves outside of the cultural norms and would create a bad business. It's just like we would never invest in a non-Indian in India. Impossible. In Africa, we do have some expats. But when it comes to our Africa portfolio, we do know that women are better employees. They just, in Africa, they are way better employees. Yeah. And in the case of Ampersand, they have a high proportion of female mechanics.
Yeah.
Hard to find, but in their maintenance division, if they can hire a female over a male, they will 100% will, because the women are more committed and they will show up for work.
It's so interesting you say that. Like, we have a whole rest of the podcast to get through, but the reason, my family has extensive businesses throughout sub-Saharan Africa, and in Kenya, we specifically have a technical training institute. And I was fortunate enough to have been there in February or March this year and taken around a tour of the institute. And the mechanical engineering class was predominantly women.
Yeah.
And I was like, shocked is too strong a word, but I was pleasantly surprised that was the case. And it's a combination of making those roles more accessible, but also it is a lot of community work in teaching, like, again, populations and communities where typically, the women were not considered natural kind of entrance into those sort of fields, to think differently, right? Yeah. And I would absolutely, I can see how the data would probably show that the women amongst your portfolio in terms of employees, etc., are far more productive. And that one of the reasons for that is because for centuries, they haven't been given the opportunity. Right. And now they have the opportunity and they are, grasping it with two hands.
Yeah. And they have families.
And they have families and they have to support them and all the rest of it. Yeah. Yeah. I mean, I think this is one of the things that is really easy sitting in the West to kind of
guess.
Well, not only guess, but like ignore or belittle or just think, well, no, I mean, that's rubbish. Like why, because we are lucky enough to live in countries where in theory there are not the same barriers. Clearly there are, right? We know that there are barriers, both in terms of gender as well as in terms of race. But in those communities, often those barriers are so systemic that, we're talking about generational changes to get to a similar playing field to what we have even today, right? Say in the UK or the US. But that's a really incredible, it's just an incredible lens to view it through. I mean, the other thing we also know is, educating women is the surest and fastest way to raise income levels, reduce poverty, and improve national economic statistics, right? Like it's the studies have conclusively shown that.
For sure.
So, okay, well, look, again, we could probably talk about this for a lot longer. So I want to move on to the other, one of the other topics that, again, I'm really keen on getting your perspective on, and that's the India-Africa relationship, right? Like, it sounds like a cliche until it really isn't. So firstly, why is no one really looking at that corridor? And what are the trends that everyone else is missing? Mainly because Africa, at the very least, is seen as kind of too hard, right? It's often put into that, the risks are too high. I don't understand, like, okay, the legal system, corruption, et cetera, right? And where does a corridor really work today, right? Is it distribution? Is it regulatory arbitrage? Like I think about pharmaceuticals, Nigeria, India, you have a lot of that sort of stuff. Is it talent? Is it playbooks? Or is it something else, right? And where does copy paste equally fail, right? Like, you can't necessarily just port a company from India into Africa. And would you ever use India's now maturing kind of IPO private equity markets, which over the last few years have definitely been growing, to finance or exit African bets? And give us a live example of kind of where learnings or teams move productively between the two.
Yeah, of course. Well, I think what investors are really missing is that 75% of the world's growth will take place in the Western Indian Ocean region, meaning East Africa and India. And I believe that's by 2050, if not sooner. So we're really looking at the largest population growth on the planet occurring in that region. And so why do these two regions go together, but why is nobody else thinking about them? Well, I mean, I'll just simply say that people often say, like, India's 10 years behind the US and Africa's 10 years behind India. I think that is a misstatement in the sense that, to your point, India and Africa are quite linked historically due to populations, the Indian diaspora in Africa.
Trading routes.
Routes. And then also I'm perceiving a shift of power on the globe at this moment in time with more unpredictable U.S. I think Asia is really strengthening. And we have seen the Japanese government put in place what they call a Western Indian Ocean strategy recently, where they will be funding fund managers and companies through their development finance institution in both Africa and India, kind of in one pot of capital. So there is growing recognition for this. To talk a little bit more about where this connection comes from, I think in niche areas it's regulatory. I think a lot of it is really playbook. I think that Africa and the kind of lower income aspirational consumer population is demanding very similar need to haves that Indians are. They're coming in different ways, and I'll kind of share a couple examples where I don't think the copy paste works, but I really do believe that number one, this is just a playbook strategy, but it's also a human capital strategy. And we see African companies sourcing talent in India because the biggest problem with Africa and investing on the continent, I agree, let's not lump it, but in my observation as an investor, primarily out of East Africa, but with portfolio companies that are operating across 13 countries on the continent, the biggest problem is human capital.
Yeah.
It's not corruption.
Absolutely.
It's not currency. Those things are hedgeable. They are predictable. Frankly, they happen in all jurisdictions. It's just they're written in different ways. They're in different codes, but it's human capital. There isn't enough startup talent. So what we've seen companies do in Africa is outsource their talent to India. And it's perfect because it's a similar cost or cheaper because of the supply-demand issue with human capital in Africa. The best human capital is quite expensive. So it's actually cheaper. And it's either AI now, because all companies that are worthy of investment are AI native. Even if it's, in a simple way, they have AI in their DNA. Of course, it's tech, and then it's finance.
Yep.
It's CPAs. Yeah, exactly. So I think you know what I'm talking about here. So those are really the two ways that I perceive India and Africa to be significantly linked. To share an example, we have two ag businesses in the portfolio. One in India that is further along than the other in kind of its distribution and impact on the agricultural ecosystem. It's called Fussel. It's a digital scarecrow. In other words, it's a stake in the ground for horticulture farmers. It's a true AI-enabled IoT device. Yeah. And this company is selling their product not only in India, but in Southeast Asia, and their next market is Africa. And so we have another portfolio company in Africa and Kenya that is turning idle land into income. I'm sure you know there are a lot of small holders or landowners that have upcountry land and just have a plot of land that is family owned, but is completely unproductive.
Yeah, or they haven't rotated enough and they've kind of, killed the soil.
Right. And so as inflation gets out of control, prices get higher, wages stagnate, your average Kenyan is needing to monetize that land. And so what this company does is they lease that land and they create mosaic farming to meet commercial contracts for potatoes, for chips, all the way through castor seeds for castor seed oil, to pyrethrum flowers for insect repellent at the global level. And these two companies are talking, and there's an opportunity for there to kind of be a synergy between the tech ag piece that comes more out of India, the ag tech, and then the kind of basically strategy to capitalize or build upon
It's the aggregation
the continent,
of
the continent with the most arable land.
Yeah, yeah.
65% of the arable land on the planet is in Africa.
Yeah, that's
So that's
crazy.
another example. We also have an EV leasing platform. I already spoke about Ampersand, which hires the female mechanics. But the EV leasing platform could also help get some of those assets off Ampersand's balance sheet. So Ampersand can just purely be the operator of this battery swap network. So we see a lot of synergies. Where things fail, end-to-end tech. That's what it comes down to. Indians are willing at all levels to open up that app and their phone. They're more smartphone enabled. They're more tech enabled. I mean, the universal payments and the payment infrastructure that the Indian government has enabled have really set kind of like this awareness on fire, whereas in Africa, tech assisted is what is really, really required. Your average consumer needs to have some sort of human interaction before making that transaction.
And often they don't have access to the device, right? Like, so whereas in India, you will go, the Indians will go out and buy a $50 Android phone.
Right.
In Africa, you've still got people on kind of Nokia-esque tech, right? Because the most that a lot of them are using it for is M-Pesa, for example, because they are unbanked. They don't have need to access like an online banking system. They're not, they're not insured. They don't have bills online, all this sort of stuff. And do you think that that's changing out of interest? Like, do you because there's an adoption curve where I assume as tech matures and as it becomes more commonplace, it'll force people to adopt the tech and the hardware that essentially you would use to access that tech, right? Do you see that happening in Africa? Like I would assume, say in Nigeria, it's maybe slightly more advanced than it is in Kenya, for argument's sake, right?
It is, but I think when it comes to even like investment in savings, there are certain sectors where it still is just, people, consumers, savers will continue to walk into our portfolio companies' offices or need a hotline to be able to talk to somebody about what it looks like to save for their children's school fees.
There's also a trust element there as well, right?
Yeah, again, this is like the approximation of trust is the calibration of trust is very different in both environments. So I don't think it's changed, nor do I think it is changing yet. But what African companies can do is use it to their advantage. What can they collect? Data. Yeah. They can collect way more data that way. And, we do have a long tail India business in the portfolio that is distributing products in rural India, effectively like kind of the third wave of India, 800 million people that are, becoming aspirational consumers. And that company also uses their human assistants to capture data. They walk into somebody's small home while they're collecting the order for diapers and, maybe one other kind of fast moving consumer good product. They'll look around and they'll say kitchen, television, Fanta on the counter, tick, 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 build the data set.
Yeah.
So as long as companies are using this need appropriately, it can create really strong business models. Yeah,
there's a couple of things that I want to dig into there. So obviously the human capital side, I understand fundamentally, and you've met one of my cousins, and their business essentially is human capital from India to Africa. Actually, what they're also seeing now is Africa to India talent as well, right? So potentially, I guess maybe cheaper developers or cheaper accountants, although I think India has enough accountants for sure. And senior management often, certainly corporates will import senior management from India into Africa rather. And then it's about how do you train the next generation, right? And how do you ensure that boards are representative of the right talent mix? How do you ensure management is representative of the right talent mix? Because what you don't want, and you said, whilst you in India, you don't invest in sort of non-Indians in India, but in Africa, you have one or two expats that you've invested in there, and that's maybe because Africa to that extent probably still has a hangover from the 70s, 80s of a number of expats who've remained, and by expats, and then you have strong like UN presence and all this sort of stuff. So you have a lot more kind of a lot more people from across the globe kind of in some of these places, but that human capital aspect is super interesting because it ties into a couple of things, right? So it also ties into your point about non-technology led data collection, right? Because you can only do that in a world where your cost of people is relatively low, right? So there's an arbitrage that you're essentially able to do. You couldn't do that in the UK because it would be like crazy to send, to send individuals out to homes to try and capture data. Like it would just be completely non-cost effective, right? Whereas in India or in Africa, you can get away with that. I still remember, every time I get into an Uber in Kenya, I'm like shocked that it costs me £2 to go across the city or whatever, right? Like, there is that, there is that sort of cost of labor, which is obviously a huge amount cheaper. So that's one thing. And the second thing, I think, and I'd be interested in your perspective of this. Does India, because I can see Africa thinking about India and emulating some of the stuff in India, whether that's tech, whether that's other things. But do you think India thinks about Africa?
100%.
Really?
Yes.
Really?
Investors are thinking about Africa and companies are thinking about Africa.
That's
when they're thinking about where they can build in their next markets. Because I've observed that Vietnam and Malaysia and other parts of Southeast Asia are quite crowded as an entrepreneurial ecosystem, and Africa is has the same challenges or the same needs, and therefore the same problem statements. It's just like there are tweaks required.
There's localization.
But yes, I see investors and portfolio companies looking into Africa almost first in their market expansion.
So why? Okay, I know this may sound like an obvious question, but why is the West not looking at Africa?
I think that we're very good at navel gazing in the West. Yeah. It's not the way that you or I were raised. Again, my father grew up on the continent, so I was raised in a very different way, and I'm a New Yorker. I think that says a lot. But I think the West is very good at navel gazing, and frankly, the West is really interested in or at least the U.S. is extremely interested in get rich quick schemes.
And Africa's a slow burn.
And Africa is a longer term opportunity. Now we have a 3-year debt opportunities fund with it's fully closed and baked, so I'm not selling, but it's a 12% net return, and it's on track to return that. When interest rates are higher in the US or Europe, I get why that risk return may not be worth somebody's time, but as interest rates start to drop, that number is not changing.
And they are dropping.
And I think that's when investors really start to wake up. But ultimately, I think the home bias is something that's like psychologically difficult to overcome, just like climate change comes along with a tremendous amount of cognitive dissonance. I think that I sleep really well at night, even though it is a long game for me, knowing that as a fund manager focused on the future of global growth, one day the global growth is going to smack investors in the face, and I'm going to be right.
You heard it here first.
Yes.
Eva is going to be right. Right. No, look, I'm super bullish on Africa, right? I wish I could do more. And we've actively, courted a couple of African startups to assist with a kind of CFO type support that we offer. We've also, offered to help them find some investors in the past, or introduce them to investors, I should say. And the thing, here's why I'm bullish, right? So there's one company that I know, I think I've talked to you about it before. It is in, it's essentially aggregating logistics, right? So it's a marketplace for logistics. So you have, you have, as you know, in Africa, you will often be shipping by road, freighting by road over massive distances, product across certainly East Africa, right? So you'll have goods arrive in Mombasa and they're then getting shipped into Rwanda, or they're
DRC.
Yeah, exactly. Or into Tanzania or wherever, right? And obviously not all containers can go out full. So these guys have essentially figured out how to aggregate, go to the smallholders, also find the spare capacity amongst the trucking fleets and match the two, right? And they're called RideLink, for those that want to know. But these founders, right, they got to 3 million GMV, I think, rough numbers, with $300,000 of capital invested in the business. Like, and that's the reason I'm long, because you can make your dollar last longer, but also because, you know, in Africa in general, like the expectation is no one is going to back you, right? The expectation is I'm not going to find an investor. I'm going to have to do this. You know, I'm going to have to do it scrappily. I'm not going to have friends and family. You know,
there's no rich uncle.
Yeah, there's no rich uncle. Or if there is, like, they're interested in property more than anything else.
Exactly.
Because it's still
well
Africa.
said.
I mean, like, my family, like, they approach it. They're like, okay, we're looking at doing this thing. I'm like, okay, what is it? We're investing in a startup. I'm like, okay, great. Let me know. And it, you know, it wasn't a startup. It was like a REIT business, right? It was like a property play, which is great, brilliant. But, you know, it's a different risk profile, right? But the point is that these guys, and, you know, then they got accepted on the Morgan Stanley kind of program, and, you know, so on and so forth. And the reason I'm bullish, not necessarily just about that business, but in general, is because I know that, you know, if I invest, argument's sake, 50K into a business in Africa, as long as I am clear, to your point, and have done that diligence and the relationship has been built with the founders, I'm clear that if everything is kind of above board and kosher, like that $50,000 is going to get you a hell of a lot farther than it gets you in the UK or the US, right? And often because, you know, unlike the UK and US, and certainly unlike the US, I think the UK is still a bit of a basket case about this sort of stuff as well. In the US, you can fail, get up and go again. In Africa, you can't really necessarily do that, right? Like if you fail, you're probably done. So you only have that one opportunity. So the founders that really go for it in Africa, they're going for it, right? And I think, okay, one could argue that across the world that's the case, but I think there is a hunger, you know, in places like Kenya, like Nigeria, like DRC, Tanzania, Uganda, wherever, which is, you know, you're seeing the world around you developing at such fast pace, and you want a piece of that action. But also you want to build your country up as well. Like I get the impression that a lot of founders in Africa are thinking about it from that national perspective or continental perspective potentially. Like when I talk to African founders, like I spoke to someone, I don't think it was a product that would work, but like he wanted to solve cross-border currency payments across Africa. Like he wasn't thinking about how do I bank wherever, right? Zimbabwe. Mm-hmm. He was like, how do I ensure that a farmer in Zimbabwe can transact with a supplier in Nigeria without any problems, right? And I feel like that's the other second big unlock. And one of the reasons I'm bullish is there will come a time where, like COMESA, the East African kind of trade agreement, you will see a Pan-African kind of trade agreement. And once that happens, and you have cross-border trade that is essentially frictionless, like the opportunity is immense.
Absolutely.
Yeah.
And the answer, the technology that I've seen work for this so far is stablecoin.
Yeah, of course.
Right. And there's some other, you know, kind of firms or companies using even Bitcoin. I certainly agree. I think there are a couple ingredients, though, that I think are really important for the African ecosystem, and it's lean innovation, like leveraging that lean innovation, and making sure that you're kind of leveraging the right cost system, because we have seen very high burns on the continent too because of the expat talent and the human capital issue. So some founders just need to be much more aware of that, and then also making sure that you do know where your money might come from in the next round a little bit early, and being able to tell your story to get there.
Yeah. And I think, well, like I always talk about narrative over numbers. I think storytelling is the biggest gift, and you know, the right way to sell your product as well as raise capital, etc. Right? Like it has to be about the vision and the story rather than just pure numbers. Certainly at the early stages, right? But again, like I think that's where Africa has an opportunity, because it is an opportunity, right? Like it is like the size and scale of the potential is there. And I think anyone who has spent any time in Africa sees that, right? And can see that. And even, you know, even if I think about, you know, Nairobi, where you and I have, you know, both spent a fair amount of time, like just the highway that goes from, you know, the airport to essentially the, you know, the city, which took a journey that could occasionally take an hour and a half to 2 hours because you were snarled up in traffic, is now like 15 minutes, right? Like, and it's just opened up that commute, which just makes everything else like super simple, right? And I think because you're starting from that low base, the opportunity is that much higher. Absolutely. I want to switch tack a little bit, right? So obviously everyone is talking about AI, and like, you know, I feel like I have an obligation to talk about it on this podcast as much as I don't necessarily want to. But look, is AI a leapfrog or a dependency, right? And what I mean is, you know, you've got scarce compute, you've got messy data, you've got 100 plus languages. So what AI stacks are really working across your portfolio? Is it on-device small models? Is it like sort of edge computing? Is it agent workflows for field ops? Is it hybrid, like human in the loop? And what is one unsexy kind of AI use case in Africa or in India that you think might outperform Western equivalents? And on the flip side, I guess, what breaks if the big model providers change access or pricing, right? Because I don't think anyone is building an LLM in Africa.
No, they're still using open source. Yeah. It's an interesting question about what breaks. I almost want to start there first because I don't know actually the answer to that question. And I say that because I think AI native companies need to start understanding the risk of using AI. But 80% of our portfolio companies in Fund 2 are AI native. And what we're seeing is everything from insurance claims underwriting, kind of algorithmic predictive AI usage for what will the claim be, what will the payout be, just basically kind of automating and using agentic AI as well in the process of cutting out some of the human capital required, again, a la this human capital problem, right? So solving for that big issue. So we see that in a company called Eden Care in the portfolio that is a SaaS for claims processing. We see AI playing a role in the data analytics. So, again, lighter version of AI, but still native to the company in Ampersand, where they're understanding the battery usage. We're seeing AI also be a completely new business line for one of our African portfolio companies in the femtech space called Kasha. And they're selling everything a woman buys, not only women's health, but everything a household buys, really recognizing the power of the female consumer. But they've also been able to understand where some of the health products need to be using AI predictive models, particularly around HIV.
Well, I was going to say, because presumably some of these products are not products that a woman in Africa or in India would necessarily feel comfortable buying as part of the household spend, kind of thing.
Right. So, I mean, it is a Trojan horse. That is the business model. It's a Trojan horse for women's health. But they've been able to attract some pretty big contracts into the $50 million, maybe even more than that in 2026, around distributing effectively and more efficiently antiretrovirals. So they do kind of like household pharmaceutical distribution. In India, I mentioned Fossil already, the IoT hardware side. The individual stake is getting smarter on its own in terms of the recommendations it can make to farmers. So none of this is, some of it's human in the loop. Some of it is agentic in the sense of, again, cutting out that human capital. But a lot of it is just kind of, more open source, training open source LLMs with data to make better predictions and have stronger outcomes around the businesses, around the business models. And
which, again, to your earlier point, is massively useful, because in the part, if you've got like people wandering into people's kitchens to like collect data, that's a hard to scale model. Whereas if you can augment that with AI, which 4 years ago, you couldn't. And if you can do that quickly enough, then you can create an edge, right?
Yeah, it becomes monetizable in that case. To answer your question, I forgot the middle question.
No, so really, what is it? Well, you've talked about unsexy AI use cases, maybe, but and you've already answered, like it's happening sort of agentic workflows and so on. But
unsexy is a tough term because unsexy presumes that the other is sexy. Do I think that
is anything in AI sexy?
AI in the US is sexy at all? Yeah. The answer is no. Yeah. I actually think the application of AI within need to haves in large populations where data is unknown and requires perhaps just a larger power to process is where AI gets really sexy. I mean, most of the products and services created on this planet are mostly created where the larger ones, Google, Meta, et cetera, are created for the West. Yeah. Whereas AI, I think, enables Africa and India to build for itself and to build more relevant data sets that then create even better products and services for those markets. But to me, that's sexy. So I guess the question is, what's the definition?
Yeah, like I said, I hate talking about AI because I think there's so much misinformation or kind of, everyone's talking about Sora. Is Sora really like the use case for AI that anyone cares about? No, not really, right? Like, I mean, do we need, whatever Meta's put out now, AI videos that, you can scroll as if it was Instagram? It's just like, no, this, just don't want to even look at that or think about it. But obviously for a huge kind of swathe of people, it's like, wow, that's so cool. And it's like, that's amazing that we can do that. And I'm like, okay, but who's solving, like, exactly as your portfolio is, who is solving like women's healthcare using AI, like in a sensible way? And that is sexy because, like, all of a sudden, to your point, you're serving underserved populations in a way that just wasn't even feasible like several years ago. And I think that is really cool. And I think that is, I think that is the definition of sexy, because all of a sudden you are not only mobilizing, but you are essentially including swathes of the population that previously were not included. Yeah. And from there, who knows what else will happen, right? Like, what are the second order, third order effects of that having happened, right? So yeah, I mean, my thinking is that there are use cases that will come out of India or Africa that no one has thought of, right? Absolutely. And which will have transformational impact. I mean, like, the equivalent, I guess, right, in my head is, think about something like What Three Words, which is, the geolocational mapping, which allows, so when I heard about What Three Words, I think I was out in Papua New Guinea at the time, I was like, oh, wow. I mean, like, this could absolutely be used to get medication to like a rural village or whatever. Like, and that was my first thought process, right? So exactly as GPS transformed the way we travel, the way the internet has transformed everything we do, I think AI in some of these ecosystems, some of these countries, some of these regions will change. I mean, they will change the way people do things and I think actually in a faster way than it'll change in the West. Because in the West, you will have blockers to adoption, whether that's maintaining workforces or not. As we're seeing in Europe, lots of regulation that will limit the ability to kind of displace jobs and so on. Whereas I think in places like Africa and like India, actually there'll be net job creators because they will create technology that will allow more and more people to join the workforce rather than the other way around, right? Absolutely. So because now, to your point, right, like, now you don't need 300 claims adjusters. You've got the AI agent, but you need a human in the loop. So now you can train at a more junior level claims adjusters. So you don't need someone as well trained, or not well trained, that's the wrong word, but not necessarily as deeply trained as in the past. And that will hopefully create a swathe of future kind of insurance brokers or something. I don't know. But you get my point, right? What I would hope is that the AI will become an enabler to build on top of, right? Whether that's jobs, whether that's more technology. And I think in Africa and India, that's a massive opportunity.
That's what we see.
Yeah. Okay, cool. I'm glad I got that straight. Okay, look, final kind of large question. And we sort of touched on this a little bit, right? So let's talk about Africa's kind of S-curve and the time risk tax, right? So you've said innovation in Africa isn't a Silicon Valley rocket. It's an S-curve with long tails, right? And we talked about how you think about your portfolio from that perspective. So how do you price time risk into ownership, reserves, founder comp, so that the best people don't time out or simply pass? And you lean on kind of strategic CVCs. You talked about 60% of the portcos, or in fact, actually, I think as high as 80%, maybe you said.
60.
And it was 60%, right? 60% of portcos having strategics involved either on the cap table or as partners to mitigate that. So when are they kind of force multipliers versus proof of concept kind of channel conflict? And if you could set kind of 3 rules for how corporates engage with African startups, what would they be?
So we don't invest pre-revenue, which I think also helps.
Okay.
And in your prior question about valuations, which I didn't touch on, we also, however, get good pricing in Fund 2. We invested at half the US Series A valuation on average across the portfolio. Yeah. So that means that, the upside is actually somewhat greater for us because the entry price is less expensive, although, there could be an argument made that the
risk side,
valuations or the kind of exit multiples are not as high. Yeah. But that being said, when you invest in quality, I think you do quite well. When it comes down to, again, how we think about this S curve, baking exits in from day one is very important, but also somewhat of the kind of we're not investing in too much research. We do have one deep tech company in the portfolio, but we really aim to kind of have one deep tech company in each portfolio, so in each fund, because that I think can lengthen the S curve. In other words, that tail is much longer before you hit the upswing, and that could actually time out a great, brilliant team. The other thing to think about is, does this company have enough working capital to reach the point where the kind of S starts to begin? Like the tail may be a little bit longer, but when they hit the sweet spot in the business model, whether that's, customer adoption, whether that's validation from large B2B buyers, whatever it may be, do they have the right capital stack? Often the answer is no. That's where we do a lot.
And that's not just in Africa.
No, but that is what can really, as you say, time out great companies, great ideas, great teams. And so we provide debt as a part of our debt opportunities fund, but we also help connect companies to other providers of debt capital, working capital, understanding that it is needed at a greater scale than we can provide.
And this is not venture debt, right? This is commercial debt.
It's senior secured working capital loans. Yeah. So that's another really important piece to pay attention to when thinking about this kind of S curve in emerging markets and how it is different than Western markets and Western innovation. So the acquirers are definitely, or the kind of exit pathways is definitely another way to think about that. The last thing is also just managing a portfolio of these different types of innovation curves. So again, not too much research, maybe not too much over-reliance on a consumer who could be cash strapped. We really like B2B. Sometimes we pepper in B2B2C. It sounds like we do everything, but we're very careful about what fits into the portfolio, especially as we're allocating over time.
I think, and again, it's all about downside protection, right? At the end of the day, I think the private credit fund makes immense sense, right? I think having vehicles like that are super valuable. It's not something you see much in VC in the UK or in the US, but if I think, as CFO, our biggest challenge with all the companies, all the clients that we work with is navigating, that almost certain bridge that is going to come up at some point,
right?
Where you're like, okay, you want to maximize valuation on the one side if you're raising a price round, but equally, you don't want to be in a position where you're having to kind of bend the knee and take whatever valuation because you run out of time. And obviously, fundraisers are taking longer. Time to close is taking longer, right? Last year was taking, even 9 months to close a round, and the UK is different from the US from that perspective in any case. But I think in the US it was still taking longer than previously. But actually, layering, and of course in the UK and the US, it's just much less likely for companies to raise any kind of non-dilutive capital until they're quite far along, right? Like
Right.
Series B plus, possibly at Series A, there may be some revenue-based financing, etc. Right? But I think it's that working capital piece, because it is often just about, okay, how, like we have contracts, sign contracts coming in, but we've got, you know, a month that we need to bridge. How do we deal with that? And like in the UK, there are no lenders that can deal with that. Like they just won't, right? Whereas I think, and again, you're not offering this to the wider market. You're only offering it to your portfolio. So you have a distinct understanding of how that, you know, how that's going to play out. And I think that's an obviously sensible way of mitigating some of your risk, giving the companies in the portfolio the best chance at success, and you know, ensuring that you're around to essentially, you know, return the capital, or they are around to return the capital at some point in the future.
Absolutely. And I think when it comes to the 10-year fund life, the last thing I would say is I feel really comfortable in our underwriting that it will take work, but we will have the majority of our exits within that timeline. Of course, we have 2 one-year extensions built in. Similarly, we structure our loans to be commensurate with our 3-year fund life. So it isn't tricky for us to get capital back. I would just say it's interesting that there's less working capital available here in the UK. I think at the end of the day, it comes down to risk tolerance and really understanding the risk of a portfolio company. But for us, you know, we lend to companies that are not EBITDA positive yet. Just because we understand the history of their working capital needs and their ability to repay.
I think in the West, what it comes down to is obviously, yes, there's a risk aversion, but equally there are, you know, startups are a very small kind of part of the SME ecosystem, if I can put it that way. There are plenty of businesses that are more secure that you can lend to. So what we tend to see here is, yes, you see revenue-based financing at the earlier stages, which is, you know, is a great solution. And, you know, the first time I came across it was, you know, in 2017, 18. And you know, really unlocked some working capital for one of the companies I was working with at the time. That equally has become like, it's, you know, again, that's changed because again, that was at the point where interest rates were at 0. You know, now you've got a slightly higher interest rate environment, so that's changed that profile a little bit. I also think that, you know, venture debt in the UK, for example, is far less mature than it is in the US.
Right.
And again, that's typically at Series B plus anyway. But I think there is, I mean, in the UK especially, because we culturally, and it's the way the UK thinks about these things, right? Like there is this really, there's obviously a very, very negative connotation to taking on debt at the personal level. And then that kind of translates to the business level, even though like, so as someone who's run businesses for 20 years, I'm like, yeah, give me anyone's money. Like just, I'd rather use someone else's than my own. The UK psyche is better not to get into debt. And then that runs into the government and political kind of situation as well, right? And so, yeah, so I think it's a combination of factors, which just means it's harder to get your hands on kind of that sort of debt. Yes, overdrafts, fine, etc. But rotating lines of credit, you know, working capital loans, all of that sort of stuff is a lot harder. Even quite well-performing businesses with a hardware component struggle to get asset-backed financing, lease financing, etc. It's just because, you know, from a risk perspective, there's far more less risky businesses out there that they can back. Whereas again, I think in Africa, A, your yields are quite good, but B, you know, there are not fewer, maybe that, you know, I think that's maybe wrong, but there's a broader landscape, so you can choose to dip into slightly more risky businesses. Sure. And again, if you're only backing your portfolio companies, then you have intrinsically inside information that you can use, right? As we round off the conversation, I have a couple of questions which I ask all my guests. So what is one thing that you have a contrarian conviction about from any area of life, whether that's work, politics, socially or at home?
I believe that happiness follows impact. I don't mean only social or climate impact. I mean just impact and building something bigger than yourself. And I do believe that I will think about the impact that I've had from a business perspective when I die, not just my family. I love my family, but that's pretty contrarian in certain circles.
In certain circles, for sure.
Yeah.
So I think about that in two ways. So I don't disagree, right? I always think about it in terms of legacy rather than necessarily happiness as such. But I guess those two are potentially sort of intertwined. But, you know, there is this school of thought that happiness. So there's a school of thought that you will find happiness, right?
Yeah.
If this happens, then happiness will come. My slightly contrarian thinking on that is happiness is something you are. It's not something you achieve, right?
Yep.
But the second part to it is where I agree with you. Why be on this earth if you're not going to do something that's going to be valuable?
Yep.
Right. And however you value that, but however you think about what that value is, right? For you, it'll be about what you're doing in business. For me, it might be the business, or it might be this podcast, or it might be, you know, something else. For others, it'll be seeing their kids grow up. For others, it'll be, you know, just living a good life, right?
Sure.
Whatever it might be. But I think we live in a time where you have so much opportunity to make a difference.
Yeah.
Why not make a difference? I mean, I think that's the way I would agree with you. I'm going to have a think about that actually, because yeah, that is quite different to some of the opinions I've heard.
Yeah.
And finally, so that we can get to know the real you, although I feel we've probably gotten to know the real you a fair amount. What is something that moves you emotionally?
I'm moved by connecting on a feeling level with other people. I did a program called the Hoffman Process over 2 years ago, and it helped me kind of clear away some of the patterns that I acquired from my parents. We all acquire patterns. It's not my parents' fault. They're amazing. But it's just, you know, growing up as a child and modeling your parents' behavior. And what that helped me do was really be free and connect more with other humans. And I realized, I used to think I was an introvert, but it's just that I'm a New Yorker, and in New York, you kind of ignore people. So you think you're an introvert. I'm not an introvert. I'm actually a people person, but connecting on the feeling level is very important to me and moves me emotionally.
I think that's lovely. Yeah, I mean, I studied languages, which had, as far as I was concerned, had nothing to do with learning the language, because I spoke both languages pretty well. But what it enabled me to do was speak to more people.
Right.
And you know, from everything we've talked about on today's podcast, and from what I've learned about you in any case, I think you and I have that in common. We're both sort of relationship driven and proper, like, so I think a lot of people think about relationships quite transactionally, you know, but one of the reasons I built this podcast was so I could build deeper relationships with people, right? Because now I'm not, you know, I haven't sat for just 30 minutes on a Zoom call with you. I've spent an hour and a half with you, and we've had a chat, and we've talked about other stuff before, and we'll talk about other stuff after. But I think that's lovely. And I think the world would be a lot better place if more people had that sort of an attitude. Eva, it's been absolutely fantastic having you on the podcast. For our listeners, where can they find you online? Are you on LinkedIn? Are you on Twitter or X? Where's the best place for them to find you on the internet?
They can find me on LinkedIn. I'm also on Instagram at Conscious Investor, and they can learn more about Beyond Capital Ventures and my podcast, my book, through those two channels.
Amazing. Oh, and we have a copy of the book here, so small plug. It is called The Good Your Money Can Do. I have yet to read this, so I am going to do that. Give a quick synopsis, if you would.
Yeah, the purpose of the book is really to help people understand that they can use all their resources to line up their values, no matter what their values are. Understanding that everybody's values are different, but money, time, talent, skill, will, whatever it may be, voice, vote, they can use all their resources and line them up with their values to frankly feel the impact and see that impact and happiness be correlated.
Amazing. Well, Eva, thank you so much for joining me today. It's been an absolute blast.
Thank you for having me.